That's what they do, right? So we'll do the practice question also. How many practice questions are there? Oh, a lot of practice question. 3, 4, 5, 6, 7, right? 8, 9, 10, 11. Wow, wow, wow. 12, 13. Okay, we'll not do practice question for a reason, right? Practice question fun is when you have understood the 17 question. Tomorrow it will lot of fun, right, guys? So what I'll do is, see, I wanted to cover this chapter properly because we are coming back to now do theoretical subject. The 17 questions, right? We will not do questions today only for reason. I don't want you to see the questions also. Please don't go and check the answer because then it is no fun, right? So what, which is again, we have, okay, tomorrow we'll complete. So it will, Thursday it will complete, right? Most probably. It's a big topic at 30, wow, 37 questions, right? But good part is, right? Good part is that if you do questions here, for what the exam, you don't have to worry about when you go. All right, guys, let's start. Okay, so as discussed in the last class, right, we have to kind of start doing your practice questions, right? And as I told you many times in CFA preparation, right, practice question is the key to passing, right? So your reading subject is also fine. I'm not denying that. But the ultimate way to pass subject is getting a very strong command over your practice question, right? So that's why we have included all practice question in the, kind of preparation here, right? So Akihiku Takabe has designed a sophisticated forecasting model which predicts the movements in the overall stock market. Fine. In the hope of earning a return in excess of a fair return for the risk involved. Okay, fine. He uses the predictions of the model to decide whether to buy, hold, or sell the shares of an index fund. Perfect. That aims to replicate the movement of the stock market. Takabe would best be characterized as what? Right. So now it's a very interesting question, right? Because hedger is somebody who is like, maybe you have not heard this point, but just I want to reiterate. Hedger is somebody who is hedging, right? Now, always remember somebody will hedge only when somebody has an asset, right? So simple words, like if you have to understand hedging is like we all have a house, right? So if you think of your house, right, and if you are not living in a flat or something like that, right? So every house has generally, boundary wall or, kind of what you say, garden and trees around, right? Why do we have boundary wall and garden and trees around the house? Because we are trying to kind of save our house from intruders, etc. And we call it a hedge, right? We call it a hedge, right? That there is a beautiful hedge around my house, etc. Right? So hedge is generally built when you have a house, right? Why I'm giving you this example is to tell you that house is an asset. House is an asset. Hedging is done when you have an asset, right? You don't do hedging without an asset. So if this question would have told that he has some asset, the person has some asset and he's trying to save that asset, then it would have been a hedger, right? Which it has not been told. It is just told that he is trying to follow a particular model to buy or sell, right? So he's not a hedger. Investor is somebody who's investing for the long term, right? So again, this is not an investor also because he's using the prediction to buy, hold, or sell the share of an index fund to replicate the movement of the stock market, right? So he's replicating something, right? He's not kind of investing, right? He might be buying for some reason, but he's not investing that he's thinking that, okay, let me buy at a cheaper rate and let me go and, sell at a higher rate, right? So the idea is that he's very clear that he has to outperform the benchmark, earning a return in excess of the fair return of the risk involved. Not an investor, he is an information motivated trader. Again, ultimately, you have to eliminate the options, right? And you have to read. And it's very important that we read the answer also, right, which is given here. Takabe is best characterized as an information motivated trader. Takabe believes that his model provides him the superior information about the movement in the stock market. His motive of trading is to profit from the information, right? So that's straightforward, right? First question was not that difficult. Let's go to the second question, right? James Beach is young and has substantial wealth. Perfect. A significant portion of his stock portfolio consists of emerging market stocks that offer relatively high expected return at the cost of relatively high risk. Okay, return is high when the risk is high, and emerging markets make sense, right? Beach believes that investment in emerging market stock is appropriate for him. Okay. Given his ability and willingness to take risk. Perfect. Which of the following level must more appropriately describe Beach, right? Very interesting, right? Now, again, he's someone who is having a stock portfolio consisting of your emerging market stock, and he's looking at your, what do you say, relatively high expected return at the cost of relatively high risk. And he's also saying that it is good because he has more ability and willingness. So he is very learned kind of person, right? Again, he's not hedging because he's not. Okay, now this is interesting. They are also saying James Beach is young and a substantial wealth, so he has a lot of money also, right? So is he trying to save his wealth, right? That's the question which comes to mind, right? Is he trying to save up his wealth? Because a significant proportion of his stock portfolio consists of emerging market stocks that offer a relatively high expected return. Again, it is nowhere given in the question that he's trying to hedge it. He's trying to save his wealth or etc. Right? That's not given, right? Again, you look at investor information. Looks like information motivated trader, but let's look at the answer, right? It's a little tricky, so let's read what is the answer here. But I think it's C only, right? No, B, right? Beach is an investor is simply investing in risky asset consistent with his level of risk aversion. Beach is not hedging. We got it. Any existing risk by using information to identify. Okay, fine, right? So see, that's the interesting part of CFA, right? Questions, right? So they are giving a very clear line. If you are a person who is trying to kind of hedge an asset, right? Then you are a hedger. Or if you are somebody who is using information to identify and trade mispriced securities, then you are a information motivated trader. So please understand information motivated trader. Information motivated trader is somebody who wants to use a certain information to get an advantage over the others, right? So in the previous question, right, it's a very small difference, right? In the previous question, when you go back, in the previous question, there was a line given that he uses the prediction of the model. So he hopes to earn in excess of fair return for the risk involved, right? And he uses the prediction of the model to decide whether to buy, hold, or sell the shares of an index fund, right? So that is something different we are looking at, right? So we are looking to generate excessive alpha. You're looking at mispricing, and you're looking at advantage which is giving you for mispriced securities, right? In this case, question number 2, there is nothing like that, right? It is just said that he believes that investment in emerging market stock is appropriate for him given his ability and willingness to trade, right? So there is, like, the point what I'm trying to make here is that, first of all, since in the question nothing has been written about hedging, right? So no hedging, we understand. So that was straightforward. But now the doubt was between investor and information motivated trader, right? So the difference here is information motivated trader is generally kind of saying that I have more information, I'll generate more alpha on this or that. I know the mispriced security, so I'll kind of buy and sell, etc. Here, it is just saying that he has put his money in the emerging market stocks, and it is not said anything about buying and selling and mispricing of securities. And he has taken excessive, more risk or emerging market stock because he believes it's good for his ability and willingness. So it is an investor, right? So again, little tricky, such kind of thing creates some confusion, right? And you have to be really careful, because if you don't pay attention to small words, which I also didn't pay attention, to be fair, right? You get it wrong. Okay. Next question, right? Again, same type of question. Lisa Smith owns a manufacturing company. So I already get a feeling that, she has an asset in the United States. Her company has sold goods to a customer in Brazil and will be paid will be paid in your Brazilian real. I'm already getting a feeling this is a hedger because she has sold some money in Brazil and will be paid in Brazilian real in 3 months. Smith is concerned about the possibility of Brazilian real depreciating more than the expected against the US dollar. Therefore, she is complaining to sell 3 month futures contract on the BRL. This is exactly same thing happened in the Indian market today. I don't know how many people like track Indian market, but this is exactly thing which happened in Indian market today, right? So again, I just want to give you an example just so that you remember things. I was just before your class. Actually, I was reading an article only 9 o'clock around. So that article must be somebody is worried
Sir, can
about.
I ask a quick question about currencies?
Go on.
How they are so the Chinese yuan is highly controlled, right?
Yeah, yeah. Yeah, right.
So
Chinese
they
also
don't.
there are two, the Chinese onshore and offshore. There are two currencies. So your the domestic yuan is highly controlled, but the currency which trades in your Hong Kong, that is not controlled, right? So offshore is yeah. So one is controlled, one is not controlled, right? And both trades at a different price, right? So that's the point. Yeah, go on now.
So they don't allow it to increase because they want to maximize their exports, right?
Yeah, yeah, true.
But if China is becoming like, a superpower kind of a country, then how are they managing to keep it at such a low level? When, I mean, isn't it that the currency gets pushed up automatically when, it's doing well and the economy is booming? There
Yeah,
will be
yeah. So
appreciation.
see, if you don't control the currency, that is what will obviously happen, right? That currency will go up, right? But if you control the currency, right, which China does, right? See, their biggest strength is manufacturing. China wants to keep dominating the manufacturing space, right? And only way manufacturing space can be dominated is if you are exporter, the best thing an exporter can do is keep it when the currency is weak. So they deliberately keep it weak, and what they do is that they have other mechanisms, like there are a lot of gold reserves and etc., by which they kind of manipulate the market, right? Which is again WTO, World Trade Organizations don't like it, but this is a very complex mechanism, I would say. Uh, Ideally, it should uh, go up,
Okay.
right? But what China does is China every day in the morning, right? So if you watch Bloomberg, etc., so every day in the morning, 6:30 a.m. or 6 o'clock a.m. Indian time, right? The rate comes out that today's rate is set up as this. Today's rate is set up as this, right? So their own government sets the rate, right? Kind of thing, and yeah, it's not a easy science, I would say. But yes, if currency is not controlled, then it should go up. But since they want to keep the imports, uh, you know, keep the exports competitive, right? So they kind of keep it that way because their whole economy is based on exports of goods, right? Manufacturing, right? So yeah, but again, that's a very complex mechanism. But yes, when you control a currency, you have other mechanisms like your gold reserves, your other policies, right, by which you control, right? So the normal effects which should come in a kind of a what you say independent currency or free currency, those effects doesn't come here. Okay. Uh, all right. So therefore, she is planning to sell 3 months future contract. The seller of such contract generally gains when the Brazilian real depreciate against the USD. If Smith were to sell these future contracts, he would most probably describe hedger, right? See, that is why your the whole idea which I've told you, right? Hedger is somebody who is trying to hedge an asset, right? So she has a manufacturing company. Her company has sold goods. Now she is worried about depreciation. So she has an asset, right? She has an asset. She's worried about that asset's value going down. So she is trying to hedge, right? Like a house, right? You are building a hedge around the house, right? You're building a hedge around the house, right? Because you want to protect the goods which you have sold and the value of those goods, right? So that's what you're doing, right? So it's a hedge, right? This was easy, not that difficult, right? But yes, my aim is to tell you that just understand the three differences. Understand that when you are looking for mispricing, etc., then it is the information-driven traders. When you're looking for a person who is more, not bothered about mispricing or not bothered about hedging, but he's just putting money and he's very ability and willingness kind of thing. Then he's an investor, and if somebody has already an asset and he's worried about whether he will get fully paid or not, that is a hedger, right? So this is what the hedger, right? So Smith, again, how this position is built, what this position do, I'm not touching that there because this is how this future contract works. It is discussed in your derivative chapter, right? So we don't want to get derivative right now, but just understand that uh, derivatives are used for hedging, right? Just keep this in mind. Derivatives are used for hedging, right? So derivative also have many types, which I told you earlier also, right? You have your linear derivative, non-linear derivative, and in your linear derivative, futures and your forwards are there, right? And in a non-linear derivative, generally options is the one which we focus more, right? But again, we'll go deeper in this topic, right? So this is done. Then we go to the next question. Which of the following is not a function? Which of the following is not a function of the financial system, right? So again, now we have to go into the function of the financial system, right? So that's what I'll recommend, that it's better to refer to the slide because these are questions, right? Uh, to help the economy achieve, to regulate arbitrages, profit, excess return. So this see, to facilitate borrowing by business to fund your current operations. Yes, borrowing, saving and borrowing was there, right? Not a, so this was a function. You're asking a not a function, right? To help the economy achieve allocation efficiency, I don't know. To regulate arbitrages, profit, regulate arbitrage. A and B we have to see. Economy achieve allocation efficiency and arbitrage and profit. See, we have to go back and forth because, oh, sorry, right? Yeah, so allocating capital is also there. That's why this is also a function, right? Both are function. Not a function is this. Arbitrage is not there, right? So what I'm trying to tell you here is that you have to remember it, right? There is no other option in such kind of question. You have to be very precise, and that's why we are doing this question to tell you how it works. Very, very precise, right? So option is A, right? So this is we have, right? Financial system allocates facilitates the allocation of capital to the best use and the purpose for which people use the financial system, including borrowing money, right? Then next question, investors primarily invest in stocks of publicly traded companies. The investor wants to increase the diversification of his portfolio. Perfect. A friend has recommended investing in real estate properties. Fine. The purchase of real estate would best be classified as a transaction in the what? Right. Real estate comes in what? It doesn't come in your derivative, right? It doesn't part of. Now, traditional or alternative, right? Real estate is traditional or alternative, right? That's again you sorry, if you know it clearly, right, then it's good, right? If you don't know it, then let me go to the slide. That's the only way you can see that, right? So if you real estate is traditional or alternative, real estate, go here, alternative, right? So which is C, right? Yeah, C is the answer, right? So that's fine. Okay, next question. A hedge fund holds its excess cash in 90-day commercial paper. Commercial paper is, I told you, right? It's a short-term borrowing, right? And negotiable certificates of deposit, right? CDs. There's something called CDs, I told you, right? Negotiable CDs are also called jumbo CDs. The cash management policy of the hedge fund is best described as using what, right? So you are putting in commercial paper and CDs, right? CP and CDs. Commercial paper and CDs, right? So now you are the cash management policy. Are you putting in capital market instruments? Are you putting in money market instrument? Are you putting in intermediate debt term investment, right? So again, that's the whole idea. Go back. Let's look capital, money market, or intermediate. CPs and CDs. Let's look at, but that's okay. Okay. See, CP is generally for 90 day. generally 90-day short-term borrowing. Short-term borrowing, right? So it is people borrow in the you know a small scale borrowing which happens, right? So generally this is part of your money market, right? Money market. There's a difference between capital market and money market. Money market is your basically your bond market kind of stuff, right? So uh, if you go ahead in the answer, right, the 90-day commercial paper and your negotiable CDs are your money market instruments, right? Again, understand capital markets are generally stocks, etc. Money market is like bond market, and capital market is generally like equity market, right? So remember that. Okay. Given very directly, I think they have not. They might have mentioned somewhere small point, but it's okay. An oil and gas exploration and production company announces that it is offering 30 million shares to the public at 45.50 each. Transaction is most likely a sale in, right? So again, it's not a futures market because it's not a future which is going on, right? It's a primary market or secondary market, right? So when they are announcing 30 million shares to the public, right? So public is announced. Is it a primary market or secondary market, right? It's a what is it? Any idea? Primary market, secondary market. It's a primary market, right? The transaction is a sale in the primary market. It is sale of shares from the issuer to the investor, and fund flow to the issuer security from the purchaser, right? It's a primary market. Again, primary market is, we can go back to discussion of primary market and security market also. But you go here, right? So if you go, which is this one, intermediate term debt investment, right? What I'm trying to say is, why not this answer, right? Because this is money market, also debt, intermediate term. So if the question would have written T notes, right, then it would have been your intermediate uh, term debt investment, right? But since it is written not 90 days or basically 1 to 2 years, 1 to 2 years it is written. So 1 to 2 years is generally your what you say uh, your money market, right? So that's the whole idea. Okay. Similarly, if
So,
you
so in US, it's not really a related question, but in US and Canada, the banks which have they have huge capital markets departments.
hmm,
But what
there
work
is
do those departments do? I don't think they work really in mutual funds.
no, they don't work in the mutual fund, but generally it's the categorization which is see when you talk about your capital markets in banks, right? They actually have both, right? In the banks, they have equity also, right? And they have debt also, right? But the debt which is there in your capital markets is generally corporate debt, right? It is generally corporate debt which is there, right? So what I'm trying to say is this is, there is a specific term for money market, right? Money market is generally used for a specific kind of product, right? So if you talk about capital market, right, saying that capital market does not contain debt, right, which is also not wrong, which is wrong actually. Capital market contain debt because a lot of branches of your banks, right, they have corporate loans, right, corporate loans, etc., right? So corporate debt, right, and all those things. So what I'm trying to say is that, see, in finance we use specific words, right? So money market is generally associated with CPs and CDs. Intermediate term debt in my measure instruments related with T notes. Money market is generally, see why money market is related with this, because money market is something which is considered to be very liquid, right? So when you have ultra short term borrowings, ultra short term borrowings is called money market, right? If you have to put it very simply, it is ultra short term, right? Ultra short term means your 1 day to maximum 2 years. Ultra short term and short term borrowing, right? Ultra short term to your short
Okay,
term
yeah.
borrowing. So those are called your money market.
Okay, so if a T note is 1 month, then would that be money market
Yes,
or
that
would
that,
that
that
be
that will be
intermediate?
money. That will be money market.
Okay,
right?
okay.
So that's the thing, right? See, this market has a special name for one reason, because this is very popular market, right? So this has a special name because a lot of people trade here, right? And it is used a lot by banks for borrowing, etc. Right? That's why it has a very specific name. And coming back to your point, capital market also trade debt, right? But generally they trade corporate loans and corporate debt, etc., which is not a short term. It is 10 years and more than that, right? Or 5 years and more than that, right? If we are looking for 2 to 5 year kind of treasury notes, right, then it is coming into intermediate term debt investment, right? So it's more like finding the right answer, I would say, right? It is not exactly one thing or the other, right? There is a lot of overlap, right? And that's the problem here, that one has to be a little uh, smart, right? So that is why we are doing the question, right? That's the only objective, because this is done. This is also done. Okay, this was a primary market. Yeah, this was done, right? So now another question: consider a mutual fund, right? Consider a mutual fund that invests primarily in fixed income securities that have been determined to be appropriate given the fund's investment goal. Consider a mutual fund that invests primarily in the fixed income securities that have been determined to be appropriate given the fund's investment goal, right? Which of the following is least likely to be part of the fund, right? So a mutual fund that invests primarily in fixed income securities and which is appropriate for the fund investment goal, which is least likely to be part of the fund, right? Now tell me, uh, which is the least likely? Whether it should be warrants, CPs, or repos, right?
Maybe warrants? Not sure.
Warrants, right? Because see, fixed income, commercial paper is a fixed income thing. Commercial paper is a fixed income thing. Repurchase agreement is again you are buying; it's a fixed income kind of thing, right? You're selling and buying collateral. Warrants are not a fixed income kind of thing, right? If you go back, right, we can check the answer also to be fair. But if you go back, warrants were part of equity, na? Warrants were considered. Objective is to make you realize that this is how you have to pass the exam. This is how you have to study. We are taking more time. That's okay, right? And we are not progressing ahead also too much. But the same idea, warrants is what you have to remember, right? Repos are your fixed income. Commercial paper are fixed income. Warrants are not fixed income, right? Warrants is equity. Warrants part of equity, right? So remember that, right? The notes I have shown you, right? You have to go back, right, and study it. It's a good exercise, guys, and do it, right? So here, what is given? Warrants are likely to be part of the fund. Warrant holders have the right to buy the issuer's common stock. The warrants are typically classified as equity and are least likely to be part of fixed income mutual fund. Commercial paper and repos are short-term fixed income securities, right? Ninth question, right? A friend has asked you to explain the differences between open-end and closed-end funds. Which of the following will you most likely include in your explanation? Closed-end funds are unavailable to new investor. No, there's nothing like unavailable and all that kind of thing, right? Open-ended are traded differently. Closed-ended are traded differently, right? When investors sell the shares of an open-ended fund, right, they can receive a discount or a premium to the fund's net asset value. Sometimes, yes, maybe sometimes. When selling shares, investor in the open-end fund sell the shares back to the fund. When investor in a closed-end fund sell the shares to others in the secondary market. It is telling you opposite, right? So we can go back and see the open-end versus closed-end discussion, and that will you will get more idea. Mutual funds. This also you have to understand, guys, based secondary market. Let's go here. So we have this, right? So most likely open end, yeah, same thing which is written. Open end, sell the share back to the fund. Close end, secondary market, right? Again, same. Open end, bought from the fund. Everything is in notes. Only thing is you have to go and see that close end It is bought from secondary market. Now, so what is secondary market? Secondary market is you can go and do it in Zerodha also, right? If you like, Zerodha is a web, kind of exchange in India, right? Broker in India. So you can, like you buy a stock, right? Close-end mutual fund you can buy on the exchange, right? You can place your price, etc., right? So this is what investor. Okay, and this was wrong, right? When investors sell the shares of open-end fund, they can receive a discount. No, generally, when investors sell the share of closed-end fund, they receive a discount because generally there is a liquidity issue, right? So it is opposite, right? So basically, idea is that see there is open-end fund has lot of liquidity. Lot of liquidity means the generally the mutual funds, you will say 95% of mutual funds in the world are your open-end funds. Only 5% of mutual funds in the world are your closed-end funds, right? So less liquidity, right? This is less liquidity, that is good liquidity. So less liquidity, which when you have, right, that is why when you try to buy this, right, closed-end one, right, generally receive at a discount because lack of liquidity forces the price to come down, right? So when investors sell the shares of open-end fund, they don't receive discount. Closed-end fund receive discount, right? If the line would have been closed-end fund, right, so closed-end fund, it has a discount, right? Because see, the idea here is that very less people transact here, so generally it is available at a little less price than the other, right? Less liquidity means less people transact here. Less liquidity means less people transact here, right? So remember this point, right? Small thing, but it is also a difference because see, CFA asks you very good questions, and good thing is they will ask you only from here the topics, so you have to understand. When investor want to sell the share, investor of open fund sell the shares back to the fund, where investor of closed-end fund sell the shares to the secondary market. Closed-end funds are available to new investor, but they must purchase share in the fund in the secondary market. The shares of a closed-end fund, which I told you, trade at a premium or discount to net asset value because there is less liquidity. Generally discount, but can be traded premium also, less liquidity. 95% are open-ended, 5% are only close-ended. So close-end have a liquidity issue which cause the price discrepancy. Okay. Then we go to the next question. S&P Standard & Poor's Deposit Receipt, SPDR, in an investment that tracks the S&P 500 stock market. Okay. Purchases and sales of SPDRs during an average trading day are best characterized as. So this is very interesting. Your S&P's depository receipt, SPDRs, is an investment that tracks the S&P stock market, right? So this is now your depository receipt, DRs, right? Depository receipts you have. And the idea is that they track the S&P purchases and sales of DRs, right? During an average trading day, best characterized at what, right? So you are trading an instrument, which is tracking an index, right? First of all, you look at option. Is it a primary market? It's a secondary market or secondary market? Then pooled and actively managed, right? So I think one can be a distinction between a pooled investment and active. If we are able to get a difference between pooled and actively managed, we can get at least one option eliminated, right? So let's try to understand what is the difference between pool and actively managed, right? So again, I'm going back again and again just to clarify things because I think this is a tricky kind of which we are looking at, right? Sorry, right? So which we already got that since this is tracking something, right? It is tracking S&P, tracking S&P 500, right? So it is your pooled, not actively managed, right? So this is gone. Now my only point is whether it is a primary market or secondary market, right? See, primary market we discuss, it is directly your issuer transacting with the person, right? Secondary market is something where two people are, kind of transacting, right? So purchases and sales of SPDR during an average trading day, right? Somebody else is purchasing, somebody else is selling, right? So it is your secondary, right? Primary and secondary, you need to understand. primary is when the issuer is doing with some first time selling kind of thing, right? But it is purchase and sale of this thing, so it is B. The pen is now getting stuck. But again, see small things coming in exam will trouble you, and this is how you score marks. You have to be